All right, guys. So today we are with Mark and Shannon at I2E, the team behind E3, Bridge 2, and more than $50 million invested into Oklahoma startups about what actually makes a company fundable in this ecosystem. Guys, welcome to the show.
Thank you all. Excited to be here. Appreciate the invitation.
Yes, thank you.
Absolutely. So when a founder asks you guys, what does I2E actually do? How do you guys usually answer?
So, there's a lot of startup speak, as we all know. Really what we talk about is the fact that we're an Oklahoma nonprofit, that we're a venture development firm, and our core focus or mission is really to build, launch, and grow companies, startup companies. And we do that by providing programs, advisory services, and access to capital.
Cool. And I guess what do you typically see businesses needing to look like for them to actually be in a position to take on capital? Like, where do they really need to be as far as in a situation where it really starts to make sense?
Yeah, I think that question, beauty's in the eye of the beholder. So from an investor standpoint, we're the nonprofit side of our organization. We have a sister company, Plains Ventures, that is the for-profit venture capital firm. So they have a unique lens, just like all investors. I think it really has to do with traction and how far the company has gotten in terms of traction within their market, number of customers, amount of revenue, validating whatever their MVP was or their value prop in the marketplace.
Okay. What's like a question that founders should ask you, but they're not asking you before they go to investors? Like, what's that pre-investor?
The pre-investor question.
Yeah.
I think I'm working with a company today, and they asked that exact question of, what do I need to do to become investable, and are your programs necessary? And what I say is, ignore the programs, but the outcomes or the accomplishments within the programs are what matters. And that means things like customer discovery and also being capital ready, having all of your information in a very organized fashion in a data room, understanding what the problem out there that you're solving. If they can grasp that and they're in good shape on those kinds of questions, then I feel like they're on the path to being attractive or interested by investors.
And what would you say if there's really three main things that you guys quietly do look for in a startup?
Yeah, I don't know if they're quietly, Jake, but I think conviction and resilience of a founder is super important. As it's a tough journey. The startup process, any entrepreneur will tell you that it is very challenging. And so that sort of DNA of resilience is really important. I think good listeners kind of related to that, if they can listen and take feedback, coaching is really important. And then the other, I guess I'll give you four and you can figure out which are the top three, but the ability to really understand who your customer is, and also what problem they're solving and is it worth solving. And I think those last two are sort of super critical in frankly areas that we've been challenged with in investments in the past, where maybe we didn't have a good sense of what the exact customer profile was and how important that problem was to be solved.
Sure. So you said resilience. How do you gauge that genuinely? I mean, are you looking at somebody's track record of a previous venture that they've had, or are you looking at their track record of jobs? Like, I mean, how do you really determine somebody's resilience? I consider myself extremely resilient. I will fight tooth and nail, no matter the circumstances, to try to keep whatever project I'm working on. But I mean, from an investor standpoint, you don't know my background. You don't know really my history. Are you interviewing these guys or these startups? I mean, how are you really gauging that? Just out of curiosity.
Yeah, that's a really valid assessment. We don't, what we're trying to sort of measure is grit, and we won't really understand that and know that until we walk alongside of them for a while, either before the check or after a check. But there are tests that we can see, and I talked about coachability and things like that. You can get a sense for that early on in your interactions with them. Also, in some of our programs, there are, what we might call, homework loosely. If they tackle that and they just grab it and execute against it, I think that's a really good early indicator. I call them smart users. You can tell the quality and the speed in which they tackle those tasks versus others who don't really approach it as sort of aggressively and professionally. But your point is well taken. It's over time, and then we'll figure that out. And that's the beauty. Diligence doesn't happen in a day, in a night, in a week. It's a journey, and through that diligence process, we'll figure that out.
Yeah, that makes a lot of sense. I love the word grit. That is like one of my. I try to internalize that myself of being extra gritty. It's one of my favorite ways to label, I guess, the struggle of moving forward sometimes in the struggle of growth when not all things are working in your favor. Yeah, cool. So I guess so I like what you're saying though. You do like little micro tests is what it sounds like, and it's not even really like a test, but like you're gauging based on the homework, based on the research you're giving. Are they taking it serious? Are they acting? And I guess that shows a pretty good indicator of whether somebody's really going to be super engaged in the process on their end.
I mean, I guess all of those that we talked about right now are like green flags. What are some of the red flags that you're looking for?
Yeah.
To decide if something is an actual business that's scalable, or just like a little project.
Yeah, that's a really something we deal with every day. What I find, and I think what we find, is if you have a meeting or you have a initial discussion and there's just continual dialogue, kind of one-way dialogue about the product or the service, I think that's a little bit of a red flag, because what we need to hear and want to hear is more sort of the external side of, great, you have a product. We know it won't be perfect. It may not be even an MVP yet, but what's the market telling you about that need, and who is that market? So if I don't hear things that are sort of external about what the market wants, what the market needs, and who that market is, that to me is a big red flag. It basically means, it's potentially technology in search of a market and or a very insular product development approach, which can be a real problem down the line.
Okay, so that means that the project is not proven to an extent with like at least like a test on the market. If
Yeah, that's okay if it's not, if we haven't launched an MVP or we haven't gotten into the market with our offering or whatever. But what's important is we recognize that the components and the feature set of that offering, product or service, really should be determined on our customer discovery and our market research of what's needed out there, both where the gaps are, what the competition's providing. And so, at some point, you got to just stick your head out there with a product and not over-engineer it in terms of the product development. But you can't, you need to do it in a way that that taps the need and the itch that the market has for that particular problem. So it's
Yeah, so I think you're breaking up a bit. What was that you said at the end there, Mark?
yeah, so I think it's a balance between those two of how much sort of the ready, aim, fire. You can't get stuck in the aim, but it can't be ready, fire, aim either in that approach to your early, pilot or trying to get early traction or launching your MVP.
It sounds like it's like the difference of a founder that's focused primarily on what they're building and the technology versus how can they serve the specific market. And I mean, that makes sense. You have to, at the end of the day, you could build the coolest thing, but if nobody wants to buy it, and if there's no product market fit, there's no business. So
yeah. And you stated that well, and frankly, that's super intuitive for all of us today in 2026. But if you go back, 5 years, we made mistakes in terms of investments where we didn't really know that well enough, and should have. And there are still founders who make that mistake today in the rush to get to market or to have an MVP out in the marketplace.
And how are you seeing MVPs really being validated with their testing? I mean, obviously, the more traction you can see a company have, the better. But what would you say is typically the bare minimum amount of traction that you should see in a company to want to consider even taking a look at maybe investing in them?
Again, Jake, that's if you talk to every investor, it's different. So sometimes it's we want validation by the large first customer. Sometimes it's I want to see 10, 20, 30. I think what you want to see is a repeatable sales model that's working to get customers in the door, not 100, but more than one, and hopefully one of those is a larger kind of flagship opportunity that can sort of validate the market. If you think in healthcare, it's a large hospital system. If you think in supply chain, it might be a large logistics organization or something like that. That it's not SMB, small business, although that's a really valuable space. You've got a balance of those two areas of traction.
Sure.
I guess a really interesting perspective for our listeners that are tech founders, for example. Can you walk us through like the development from having an idea, building an MVP, prototype, finding clients, up until being investable?
Yeah.
I think like going through that journey would help like a tech founder visualize what that pipeline looks like.
Yeah, well, you used the exact right word. It's a journey. And that journey is going to take a lot of twists and turns as you go through the process. In our name, embedded in our name is innovation to enterprise. So we see that continuum. We aren't as early as we might think. And by that, I mean, the things on the back of a napkin we'll hear about, but there's got to be a little bit of reality and traction when you come to us. It can't just be an idea. And so, we have what I'll call sort of pre-programming advisory to help you sort of refine things. But you have to have asked the key questions of yourself, because we're not going to, we need you to solve some of those right out of the gate. So once you've been able to do that, we can, coach you, advise you, and work with you, and then try and funnel you into a program, whether that's that you need customer discovery. You don't know that yet. You don't have a good clarity around that core customer. Or later in the game, maybe there are mentors out there that you need that are industry specific. Or maybe there is a pre-accelerator and an accelerator program that meets you where your needs are in terms of preparing you and what I say is to be capital ready. So that continuum, on the train of the entrepreneurship, there's lots of stops there, and not everybody needs everything at every stop, and so it's kind of up to us and the entrepreneur, quite frankly, to determine what we know and don't need to address, or we can sort of go from steps 1 to 3 to 5, but frankly, some need to go 1, 2, 3, 4, 5, and that's okay. It's not a race, in terms of the journey itself.
So talking a little bit about that journey, how do the organizations you're a part of with E3, Bridge 2, and then some of the other one-to-one venture advisories, how does that kind of work together as a pipeline for these organizations?
Yeah, that's a good word, pipeline. It's kind of a triage effort, and I was kind of alluding to that, is where do we need to deploy advisory services, and where do we need to deploy, our program. So again, I would kind of stress that we get a lot of founders who come to us, and they may have a pretty good sense of who their customer is. It's interesting. What I find is some of the best or better founders and more humble founders, even though they may know that, they still will go through a customer discovery process to validate that for themselves, to revalidate that. And it's a little bit of remedial, but I think what they view it as is, if I can revalidate or validate that, then as I go to the next step, I can sort of put a bow around that for my own organization, and then also for investors. So, okay, let's lock that down. We now know we've tested, and then I'm ready for those pre-accelerators or an accelerator. So that's where we kind of think about that continuum and that pipeline of that customer validation, and then some work following that to think about, okay, are we ready to get to the point where we're capital ready and we want people looking at us? You may only get, a couple of shots at talking to some of these investors. So if you're too early, then the risk is that they say, oh, I remember you, Mark. You had the technology that did this, but you lacked this. People will have a long memory for what your gaps were and what you lacked. So the more you can build your sort of your assets and your capabilities before you have that discussion, I think it's better with those core venture investors.
So Mark, can you walk us through just kind of a simple before and after of a company that came in kind of raw and left ready for investors?
Yeah. It's interesting. That scenario is fairly uncommon, but when it happens, it's really exciting. And we had one, in particular, that came in to, what I call pre-programming and working with them. And they were basically a B2C kind of Uber for babysitting service, if you will. Some nuances to that, but essentially that's what it was. So a lot of pivots and a lot of testing and identification of opportunities and programmatics. And when they came out of those programs, and as they approached investor, they were a B2B insurance verification play. So a gig economy play, which today is pretty passe, but like 10 years ago, that was kind of a new thing to have sort of, unpaid 1099 gig economy workers doing something for you. But the important thing is they went in with this one kind of idea, and they came out very different B2C, and then ended up B2B in a very different space, but functionally not that different in terms of aligning, a grouping of available resources to do a function that's needed in the marketplace. They ended up getting multiple rounds of funding by us. and we had a very healthy exit with them, and alongside of a number of our angel investors. So that was really exciting. And they, back to the green flags, great listeners, very coachable, and really wanted to understand their customers. So that to me is one of our kind of flagship success stories.
Wow.
Okay,
Cool.
from your perspective, what do like Oklahoma angel investors actually prioritize that founders consistently get wrong?
I think founders, the angels are a little bit of a mystery, but at the end of the day, most of these angels have been successful business people and or successful entrepreneurs. So they're really focused on, sales and revenue generation and, kind of fiscal maturity. Like, do you know how to manage your business from a financial standpoint? And oh, by the way, do you know how to generate revenue? Because at the end of the day, that's really what I'm looking for as an angel, to sort of grow my investment and grow. Why founders would sort of misjudge that, but I think they just don't know the persona of an angel well enough to know that these folks have a ton of, they're mostly high net worth individuals. They have a lot of places they could put their capital in a lot of less risky places than venture. So what they really look for is, okay, if I'm going to take on this risk, how quickly can I see revenue? Can I see the profitability and the financial stability that I'm looking for? So, in terms of local investors versus coastal capital, there's definitely a difference. In a lot of cases, it centers around valuations and different approach to valuations. So we'll have founders who say, "Hey, I think I can get a higher valuation in New York or in the Valley," and we're like, "Great, go get it. That's good for your company if you can truly get that." The reality is, it's more challenging than they think. But I think the difference that you find with local investors and angel investors around valuation, but also around the investment, is they have this sort of DNA of, how can I help? How can I give back? How can I be part of this, rather than just a pure financial transaction? I think that's a little bit of an economic development component and an Oklahoma thing of, let's build here. I've had success. Can I help you have success in the local market?
Makes sense. So they care more about financial gain, but also that.
Yeah, I believe they do. Now, they're not. This is not charity for them by any means, but they also, again, have been down this journey, as Jake termed it, before, probably themselves, in a business. They know the pitfalls, and especially if they're going to put their own money in it, they want to assist that entrepreneur to avoid some of those speed bumps and pitfalls.
Makes sense. Jake, you're muted.
So in market assessment and financial models, where do you see most founders going wrong?
On a financial models, they're always wrong. And that's kind of the running joke, is we know your projections are wrong. But how wrong are they is a question, and what are your assumptions in building out those financials? So I kind of call it the perils of Excel. I can throw a 10% growth rate on any revenue stream, and it looks like a hockey stick, but that doesn't make it true.
Sure.
In that regard, I think on the market assessment side, it's really the competitive analysis and the competitive response. So, the as-is process and the switching costs around that are often, I don't know if they get it wrong, but they absolutely underestimate it. They think it's easier to for folks to adopt new things but what we find is changing consumer behavior is super hard. It is hard to close new business and generate new revenue, and to create a repeatable sales process for your product or service. I mean, that's sort of the holy grail, and I think I don't know that they get it wrong, but they don't recognize the importance and/or the difficulty of that.
Sure. Yeah, that makes a lot of sense. I mean, yeah. So I guess you also see a lot of decks. And so what would you say are some slides that you see on those decks, financial projections of the sort that are pretty weak? And when you're looking to assess a company, is it a couple slides that, does it have to do with really the slides and how, strong or weak they are, or is it really just the core concept? Is there anything on these slides that could really be like a real red flag that you see they're a lot weaker than they need to be or they should be, that ends up being a red flag?
Yeah, so let me twist it slightly and talk about what the strengths are that people see. So what slides would I get rid of? I think I'd get rid of any slides beyond like number 10. I think one of the challenges is you see founders come in with a 20 slide deck or whatever, and investors just gloss over that. You've got a 10 to 15 minute window. You've got 8 to 10 slides, and you've got to get to the point on that. I think the use of funds slide is super important and often weaker than it should be. If you're going to raise $1 million or 500,000, how specifically are you going to deploy that capital, and in what areas and why, and what's the diversity of that look like? I think competition slide is generally fairly weak. I think people take a very cursory competitive matrix approach, which I kind of term the TurboTax, check on the back of the box, and we've got this, company A's got this, and the as-is process has this. I think that's less valuable than looking at an approach that I like, that's sort of XY axes. What are the important competitive characteristics, old tech, new tech, enterprise, SMB, whatever that is, and then plot your competition. That's a lot more meaningful. And also, to me, shows that the founder really has a good grasp of what they need to do to get from where they are to potentially an exit or a partnership. And then the last one is, the customer profile, and by that I mean sort of the buying cycle of, okay, how do you, this is especially true in sort of the healthcare space. Do they truly understand what it takes to close business and get to a sale, and who actually says yes in that process? So, net to your question, I think the deck can tell you a lot, both on the positive side and then on the negative side. I mean, it's showtime with that, and it's still introductory, but you can, back to my earlier comment about skipping steps. I think if you've got a really good deck, you can go from step one or not step one, but you can skip a couple steps and from the diligence because of the way you've been able to articulate things.
Sure. And so just spinning off of that, with using the use of funds, we have some software we've been developing, and we're rounding towards the end of our software, where we now have a beta. We'll have the beta available for beta testers and for debugging and all sorts of things. Just, I've never gone through this process of ever doing any sort of pitch. And I feel as though, I have been curious, when we do finish and we're ready for the beta and all the things, if we were to get funding, what would that primarily be used for? I mean, my thoughts are right now we have somewhat of a go-to-market strategy, but I assume that in where we would be in our stage of business, and what I guess my question is my assumption is that most of the funds, is it usually towards marketing, go to market, proving the process, getting revenue in the door as fast as possible? Or are you typically seeing a lot more in, actually developing the technology prior to even uh, the release? Like, where are you, what stage are you typically seeing these organizations at, and where is these funds mostly used, and where do you see it being most useful to deploy those funds?
Yeah. I think what you're hitting on is something that we like to term kind of staged capital. And, an entrepreneur has to realize that there's capital for stages and investors for stages. So if you're in that earlier development stage, there's nothing wrong with that, but nobody really wants to deploy enough capital to get you to some level of traction at that point, because there's too much risk. There's development risk, and then what investors like to see is, okay, how much capital do we need to get to that milestone? And to your point, maybe that milestone is completing the development of your prototype or your MVP, and then the next stage that you either raise capital for or look to deploy is marketing, product introduction, go to market. That's not to say that founders can't get both of those in one ask or one raise, but we had a company that was really early. They came in looking for $10 million on a $30 million pre-money. And we worked them down to, not worked, I mean, we coached them down to, let's do 2 million on 8 to 10 million, and deploy that capital, that 2 to 2.5 million, in a really intelligent way, rather than if we gave them $10 million or invested 10 million, or you can calibrate the numbers, they wouldn't have used it wisely, because marketing, they didn't know how or where or what to market yet. It's there's a little bit of a parental view here, is this is your allowance, come back to the teller window. But as an investor, I don't want to deploy more capital than's needed to get to this sort of meaningful milestone that will really tell me, is there something real here?
Yeah, that makes a lot of sense. So you're basically saying, just look at the stage that you're in and see what's a realistic milestone to get to that next stage. And for you, I mean, it sounds like an extremely responsible thing to do. It absolutely protects your downside, and it holds the founder very responsible and accountable towards, how well are they able to execute that milestone, once they then get there and we see, where they've gotten, there can be a reassessment of what's then needed after that. I mean, it makes a lot of sense. It brings a lot of clarity. I mean, we personally are finishing up the development, but having, a little bit of capital of some real experienced people could probably help make our product a lot more polished. But even if not, I'd like to at least see, once we have our beta, I guess that's the next good follow-up question is let's say you have the beta, and what would be a realistic milestone of traction that a company in our situation would ask for, that you would you think would be a fair assessment of, this determines traction, this goes to go to market? What does that process typically look like in a stage of where we currently are in our process?
Yeah, I want to just say one thing. I'm kind of talking from an I2E and an investor standpoint. If you think about it from a founder standpoint, that stage capital is also valuable because, from a dilution standpoint, I always like to say, I hope and think your company's worth as little as it ever will be. So the more capital you take on, the earlier, the more dilution to the founders. And most good investors don't want that. They need and want to be aligned with their founders in terms of engaged and incentivized founders with a big chunk of that company. So let's parcel out that capital overall. As far as traction, I think that's a discussion with an investor, but also it goes back to what we were talking about in terms of the market awareness. Is I use a little bit of a sports analogy there, and that is, what we're not trying to do with that early capital is score a touchdown. What we are trying to do is get some yardage, get some first downs, and advance the ball down the field in a meaningful way. How many yards? We don't know. But to start to show momentum and progress, this is not a drop back and throw a Hail Mary for the end zone, and we don't need that. What you need to do is determine what of those plays, what are those execution steps that are going to demonstrate success. I guarantee you that many of these companies, probably including your own, those first sales efforts, those first sales hires are not going to hit the mark. So it's going to be, trial and error. Try that, check and correct, modify that process. And, if you deployed 10 salespeople around the country and gave them the playbook, and it's the wrong playbook, that's not very capital efficient, and you burn through a lot of capital quickly. So I think the traction is, back to what I said earlier, getting some customers, getting some betas where that's possible as well, especially with big flagship clients in your industry.
That makes a lot of sense.
I mean, what are some examples of? We're talking about raising money and where it can be used, but what are some examples of raising money for the wrong reasons, or raising too much money, or raising too little money to prove the business?
Yeah. I think I talked about the raising too much. To me, it's, founders say it's really hard to raise, capital. It's distraction. I just want to do it one time. Rather than raising $1.5 million, I'm going to go raise $4 million, and then I can get back to execution. There's nothing wrong with that perspective, but it ignores sort of the capital efficiency and then also the view of the investor. In terms of, it's really how you're deploying that, which is back to what, to Jake's question about the slides and the uses of capital. If you hire a bunch of folks right out of the gate, high paid, unproven, that's a huge problem. Nobody wants to see that. Nobody wants to see you paying six figures to somebody. Provide them some options and put them on the cap table and use that as an incentive. Somebody you're trying to recruit, I want my upside to be on the equity side, not on pay me a big salary. But companies feel like we had a portfolio company, then went out and hired an individual in the sales space, and their salary was way too high. And I think it was a discussion at the board level, but it just wasn't efficient use of that capital. So you've got that, we talked about sort of fiscal maturity and financial savviness. That's where you've got to have a CEO or founder who's got that, and working with an investor who sort of holds them to that. Because I would say be really cautious with that first raise, because it might be your only raise, and it might be your only raise for a long time. So keep some dry powder and be really efficient in the way you deploy that.
Yeah, I would imagine a lot of founders actually in an early stage, they try to prove the business and just hire, I don't know, 100 developers with their first raise to look like a real company, I guess. That's the perspective that they're looking for. But yeah, that might be like the wrong first thing to do.
Yeah. You're exactly right. And I like to say that capital oftentimes is an anesthetic. So when you get capital in the door, it desensitizes problems and inefficiencies that you have as a company. And then all of a sudden you wake up and the numbness wears off and you have nothing in your bank account. So that's where again capital efficiency is super important. Founders may or may not like to hear that, but I think at the end of the day that's how the alignment of investors and founders works best.
Makes a lot of sense. So Mark, Shannon, when you guys look 5 to 10 years out, what would be we did our job super right at I2E? What would that look like for Oklahoma?
Yeah, I think there's 3 or 4 areas. If we look at sort of economic impact and impact of I2E in our efforts, jobs, fostering a tech ecosystem in Oklahoma, attracting more capital into the state, capital providers, and more founders. Founders used to say, we need more capital here, and capital providers would say, we need more deal flow. And the reality is, deal flow begets capital, which begets more capital. So I think if you look at the key indicators of success, hopefully for our efforts, is incremental companies, incremental jobs, a more visible tech sector and economy in the state. That again, one of our missions is to diversify our economy. Not away from oil and gas, but with oil and gas in mind. And more capital, more founders. Those would be good measurements.
Cool. And I guess if a founder wants to get on your radar after this episode, what is the best way to start that relationship?
Yeah, we have a really good website that's built out. So i2e.org, i2e.org, and that has both contact information and then also, I'm available at LinkedIn and respond. Most people, I think we have a decent enough reputation also that people can triangulate into us through the other investors. We've co-invested with a lot of investors nationwide, so people will know us. But the easiest is i2e.org and LinkedIn.
Cool.
Shannon, Mark, thank you a lot for taking the time to do this podcast with us. And I guess for closing, what are a few rules of thumb, just to summarize everything that we discussed, that a founder just needs to keep in mind to become investable and just continue on that growth path?
Yeah, it's maybe a little repetitive. Be humble and be creative. You're going to need to pivot. Don't be married to your initial product, and be creative enough to think about how you can pivot. I think we talked about capital efficiency. Be really efficient with your raise, because you just don't know when the next check's going to come. Something I've heard recently that I really like is, look for things that are a trampoline rather than a hammock. And by that, I think they mean, and I interpret that as things that provide a springboard, a spring and some accelerant away from and out of a program or a consulting engagement. There are hammock programs or engagements that don't really get you anywhere or not where you deserve to go. So look for those trampolines that can provide that springboard for you, out into the next stage of your business. Lastly, from a founder, funding, diversify your ask. I like to say, every no, you're getting closer to the yes. So keep don't be afraid to keep getting no's and diversify that ask. Keep asking different kinds of investors, because investors have a different appetite, and know that audience. Know, are they a tech investor? Are they a infrastructure investor? Do they like AI? Because different people, again, they'll invest in the risk that they know. And so all investors are not created equal in that regard.
Awesome. That was a great summary. And obviously, every no is a step forward towards the goal. Again, thank you so much for taking the time to jump on a podcast with us. And to our listeners, I hope you got enough information for this to build your business the right way.
Great. We appreciate the opportunity. Thanks to both of you.
Thanks, guys.
Thank you.